morning, good afternoon, and good evening to everyone who joins us from around the world.
I'm so glad you're here.
This is Andrew and Renee. Welcome to the Stack series.
Today, we are exploring systemic rupture, the mathematics of crashes in finance and biology.
You know, I have to be honest, I've spent the better part of the last week just living inside this stack of research, and I feel like I've been staring at the code of the universe.
It does feel a bit like that, doesn't it?
It really does. We have this idea of crashes, whether it's a stock market collapse or an epileptic seizure in the brain or an entire ecosystem just vanishing. We see them as chaotic, messy, unpredictable disasters.
Right. Acts of God or just monumentally bad luck.
Exactly. But the papers we have in front of us today, they suggest something completely different. They suggest there's a deep structure to the chaos, an architecture to the breakdown.
It's an unnerving thought, isn't it? We like to think a crash is a break in the system, that something went wrong.
Yeah, an aberration.
But the central thesis that connects this entire stack, and we're talking papers from Nature, from PNAS, all the way to some seriously heavy quantitative finance journals, is that the crash isn't the system breaking. The crash is a mathematical phase transition.
Like water turning to ice.
Precisely.
Huh?
It's not an accident. It's a built-in feature of how complex systems organize themselves. It's something the system does.
And what really blew my mind is the word you used before we started, consilience.
That's the key word for today, I think, consilience.
It's this idea that evidence from completely unrelated fields can suddenly jump together and form a single unified conclusion.
Yeah.
And we have that right here. We have papers on the physics of magnets, on neuroscience, on the ecology of rainforests, and on the S&P 500. And when you look at the math, they are all describing the exact same pattern of rupture.
That's it. Normally, economists sit in their tower and biologists sit in another and physicists in the third, and they never, ever speak to each other.
Right. They don't use the same language.
But today, we're going to see that a bank failure in 2008 and a species going extinct in the Amazon might actually be following the exact same mathematical laws.
That's a huge claim. So to even begin to get there, I think we have to start with the official story. Let's say I go to a university, I sign up for Economics 101. What do they tell me about how markets work? Because after reading these papers, it feels like the standard textbooks are telling us a fairy tale.
They are, in a way. I mean, they teach you what's called the standard model. And at the very heart of that model is the efficient market hypothesis.
Okay.
The basic idea is that the market is rational. It's a perfect information processor. Prices reflect everything that is currently known. And this is the critical part. They teach that price movements are essentially random. They follow Gaussian distribution.
The famous bell curve.
The bell curve. And, we see it everywhere in nature, which is why it's so seductive. Human height is the classic example.
Okay, let's just dwell on that for a second, because I think it's the perfect way to understand how wrong the model is. So if I go out and I measure the height of every adult male in, say, London, most of them are going to be clustered around an average, 5'9", 5'10", something like that. That's the big hump in the middle of the bell.
Correct. The most probable outcome. And as you move away from that average out into the tails of the curve, you find rarer and rarer events.
So you might find a guy who's 6'5". That's pretty rare.
Yep.
You might even see a professional basketball player who's 7 feet tall. That's extremely rare.
Very rare.
But, and this is the absolute crucial point, I am never, ever in a billion years going to walk down Oxford Street and see a man who is 10 miles tall.
Exactly. It's a biological impossibility. In a world governed by a bell curve, the probability of an extreme event drops to effectively zero very, very quickly.
So here's the problem. Mainstream economics treats the stock market like it's a population of human heights. It assumes that a massive crash, our 10-mile-tall man, is so statistically improbable that we can just ignore it.
We can pretend it doesn't happen. If the S&P 500 actually followed a bell curve, a crash the size of Black Monday in 1987, which was more than 20 standard deviations.
Wow.
It shouldn't happen once in a human lifetime. It shouldn't happen once in the entire history of civilization. The odds are so low, it should happen roughly once every few turnovers of the known universe.
We're talking billions and billions of years.
Yes, and yet you and I have lived through the 87 crash, the dot-com bust in 2000, the global financial crisis in 2008, the COVID crash in 2020. These impossible events seem to happen about once a decade.
So the map isn't just a little bit off, it's not just slightly inaccurate.
It's a complete fiction.
It's like trying to navigate London with a map of Middle-earth.
It's fundamentally, structurally wrong.
Yeah.
And that is why this entire stack of research throws out the economics textbook and relies on a field called econophysics.
Which sounds like a made-up word, I have to admit.
It does,
Yeah.
but it's a very serious, very rigorous field. It's essentially what happens when physicists get fed up with economists being wrong for decades and decide to just look at the data themselves.
How do they approach it differently?
They throw out the whole idea of rational actors. They don't care about human psychology, not at first. They treat the market as if it were a physical system,
Like what?
like a turbulent fluid or a box full of gas molecules or a pile of sand. They just look at the data, the price ticks, the volume, and they ask, what physical laws govern this behavior?
And when they do that, they find these, what do they call them, stylized facts.
Right, which is a very polite academic term that basically means undeniable patterns in reality that your theory completely ignores.
And the biggest one, the one that just completely kills the bell curve idea, is the concept of fat tails.
Exactly.
Okay, so explain fat tails. If human height follows a bell curve, what's a good example of something with fat tails?
Human wealth. Wealth distribution follows something called a power law, not a bell curve.
And what's the difference?
In a power law, you have millions and millions of people with very little money. That's the base. But then, as you go out into the tail, the probability doesn't drop to zero. You find people with $1 billion, then 10 billion, then 100 billion. You find an Elon Musk or a Jeff Bezos.
The 10-mile tall men.
They are the 10-mile tall man. If wealth followed a bell curve, for Jeff Bezos to exist would be a statistical impossibility on the scale of the universe. But in a power law, in a fat tail world, extreme events aren't just possible, they are an expected, baked-in feature of the system.
Okay, so that's one. The second stylized fact they mention is volatility clustering,
Right.
which sounds to me like the market has moods.
That's a perfect way to describe it. In a way, yes. The standard model, the bell curve world, says every day is an independent coin flip. What happened yesterday has absolutely zero influence on what happens today.
Which feels wrong, just intuitively.
It's completely wrong. The data shows, unequivocally, that calm days tend to cluster together, and chaotic, volatile days also cluster together.
So a big change follows a big change.
A big change makes another big change more likely. If the market dropped 5% yesterday, it is statistically far more probable that it will have another wild swing today than if yesterday was a quiet, flat day. The system has memory.
Okay, so we're building a picture of a very different kind of beast. It's not a nice, orderly bell curve. It's a system with memory, and it's capable of producing monsters, these fat tail crashes. The physicists have a word for how this kind of behavior happens. Emergence.
Emergence is one of the most beautiful and profound ideas in all of science, I think.
Explain it.
It's the idea that the whole is fundamentally different from, and often unpredictable from, its parts. The classic example is water, a single H2O molecule. It isn't wet. It doesn't have a temperature. It can't form a wave.
Right, those are properties of the group.
Those are properties that only emerge when you have billions and billions of molecules all interacting with each other according to simple rules. The complexity arises from the interaction.
So applying that to the market, a single trader isn't a crash.
Of course not. In fact, no single trader wants to lose money. No individual trader wants a crash to happen.
But when you get millions of them interacting, buying and selling, reacting to each other,
they can create this giant emergent wave, this rupture, a crash that ends up destroying them all, even though none of them intended it. To understand that process, the sources say we need a special toolkit, what they call the 4 C's.
Right, sounds like a grading scale for a diamond.
It's a toolkit for understanding complex systems. Cybernetics, which is the science of feedback loops, catastrophe theory, which we'll get to, chaos theory, and the big one, complexity theory. These are the mathematical lenses we need to start seeing the crash before it happens.
Okay, so let's use those lenses, because this is the trillion-dollar question, isn't it? Literally. Can we predict it? If the standard economists are flying blind, can the econophysicists actually see the train coming down the tracks?
Well, this is where we get into one of the most powerful concepts in the whole stack, critical slowing down.
And this idea comes straight from the biology papers, from researchers like Martin Scheffer and Vasilis Dakos.
That's right. They were studying climate shifts and lake ecosystem collapses, but the math is universal.
I found this part so fascinating because it's so physical, so intuitive. They describe a system's stability using the metaphor of a ball in a bowl.
It's the best way to visualize it. So imagine a deep, steep-sided salad bowl. You put a little marble in the exact center at the bottom.
Okay, got it.
That marble represents the current state of the system. It could be the current price, of a stock or the current temperature of the planet or the current healthy state of a population of fish in a lake. It's the equilibrium.
It's sitting there, stable.
Now, you reach in and you give it a little flick, you nudge it. That's a shock to the system. A bit of bad news hits the market. A heat wave hits the forest. What happens to the marble in that deep, steep bowl?
It rolls up the side a little bit, but gravity pulls it right back down to the bottom almost instantly. It settles quickly.
Exactly. That is a resilient, stable system. It has a high recovery rate. It absorbs shocks and returns to normal very, very quickly.
But, and this is the whole point, systems change. The bowl doesn't always stay deep and steep.
That is the absolute key. As a system gets closer and closer to a tipping point, a bifurcation in mathematical terms, the bowl itself starts to change shape. It gets flatter, shallower.
It's like the salad bowl is slowly turning into a dinner plate.
A perfect analogy.
Yeah.
So now what happens when you flick the marble?
Well, it rolls up the very gentle slope, and it just sort of, it takes a really long time to roll back to the center. It's sluggish.
That sluggishness, that slow recovery time, that is critical slowing down.
And that's the warning sign.
That is the smoke signal, because eventually the bowl can become perfectly flat. Or even worse, it can invert and become a hill. And at that point, the tiniest puff of wind, the smallest flick, sends the marble rolling off the edge, and it never, ever comes back.
That's the crash, that's the species extinction, that's the seizure.
It's the phase transition.
Okay, but here's the problem. In the real world, I can't see the bowl. When I'm looking at a stock chart or data from a rainforest, I don't see a geometric shape. So how do I know the bowl is getting flatter?
You watch the marble. You can't see the underlying stability landscape, but you can see how the system behaves in response to constant small shocks.
The day-to-day noise.
Exactly. And the sources point to 3 specific statistical signals, they call it the flicker, that tell you the bowl is disappearing from under you.
Okay, let's break these down one by one. The first one is a mouthful, increased autocorrelation.
It sounds complex, but it goes right back to the idea of memory. In a deep, steep bowl, the system resets almost instantly.
Right.
So where the marble is right now tells you almost nothing about where it was a second ago because it's always being pulled back to the center. The past is erased.
But in the flat bowl,
the marble just wanders around. It's lazy. Where it is today is highly dependent on where it was yesterday because there's no strong force pulling it back. The system gets trapped in its own recent history.
it can't shake it off.
It can't shake it off. So in financial data, if you see the correlation between today's price and yesterday's price starting to creep up and up and up, that's a huge red flag. It means the restoring force, the market's resilience, is dying.
Okay, that makes sense. So that's signal number 1. The second one is increased variance.
The wobble.
The wobble, I like that.
Think of a spinning top. When a top is spinning really fast, it's very stable, it's upright, you can poke it, and it resists you. It stays tight.
Right.
But as it starts to lose energy, as it approaches the point of collapse,
It starts to precess. It makes those wide, slow, wobbly circles before it finally falls over.
that is increased variance. Because the bowl is flat, the marble isn't held tightly in the center. Small, random pushes can send it wandering further and further away from the average.
So just before a big crash, you expect to see the daily price swings getting wilder and wilder.
Exactly. The system is exploring a much wider range of states because it's lost its anchor. It's searching for a stability that just isn't there anymore.
And the third signal is maybe the most dramatic one, flickering.
Flickering is a system behaving like a fluorescent light bulb that's about to burn out.
Yeah, that buzz and flash.
It jumps back and forth rapidly between 2 different states. In the brain, just before a major seizure, you might see groups of neurons firing in their normal healthy state and then suddenly jumping to a chaotic seizure-like state and then back again faster and faster.
And in a market.
You might see a period of eerie calm followed by a sudden violent burst of volatility and then back to calm. It's toggling.
It's the system trying to decide whether to live or die.
It's the system oscillating between the ghost of the old stable equilibrium and the basin of attraction of the new collapsed state. It can't make up its mind, and that indecision is itself a massive warning sign.
Okay, so we have the general warning signs. We know the bowl is flat, but there's a part of the stack that goes even further. It doesn't just describe the warning, it claims to model the exact shape of the bubble itself as it forms. We need to talk about what Didier Sornet calls the Dragon King. We need to talk about the log periodic power law, the LPPL.
This is some of the most fascinating and controversial work in the entire field. It comes from Sornet and his team, who are physicists, of course. And it's so powerful because it gives us a mathematical way to differentiate between a healthy boom and a sick bubble.
Which is a crucial distinction because, things going up isn't automatically bad. Compound interest is a good thing.
Right. Compound interest is exponential growth. A stock price growing at a steady 10% a year,
Yep.
that's healthy. It's sustainable. A bubble is something else. It's super exponential growth.
Super exponential. So it goes up faster than fast.
The growth rate itself is growing. And the reason for this, according to the model, is purely human psychology. It's the mechanism of herding or imitation.
The bandwagon effect.
It's the bandwagon effect, exactly. In a normal, healthy market, you have negative feedback loops that keep things in check.
Okay, what does that mean?
It means if a stock price gets too high, above its fundamental value, a group of investors we call value investors will say, whoa, that's way too expensive, and they'll start to sell.
And their selling pushes the price back down towards sanity.
It's self-correcting. It's like a thermostat. But in a bubble, that feedback loop flips from negative to positive.
And that's dangerous.
That's incredibly dangerous. Investors stop looking at the actual value of the asset. They stop caring about earnings or balance sheets. They start looking at each other.
I buy because I see you're buying.
And because you see the price going up from my purchase, you buy more.
Which makes our neighbor see the price rocketing up. So he mortgages his house and buys in too, because he thinks we're geniuses.
And it becomes a completely self-fulfilling prophecy. The belief that the price will go up is the only thing making the price go up. Mathematically, this behavior creates what's called a finite time singularity.
Meaning the price tries to go to infinity in a finite amount of time.
That's right. The equation literally breaks at a specific point in the future.
But the path to that singularity isn't a smooth rocket ship right up. And this is the core of the LPPL model. It says there is a specific signature, a fingerprint left on the crime scene.
The log periodic oscillations. This is the amazing part. The price doesn't just go straight up. It wobbles, it oscillates around that accelerating upward trend.
Like a wave riding on top of a bigger wave.
Exactly. But, and this is everything, those wobbles are not random. They follow a very strict, predictable rhythm.
The frequency of the wobbles increases.
Yes. As you get closer and closer to the day of the crash, the wobbles get faster and faster and faster.
The analogy they use in the paper, which I just loved, we have to visualize this for everyone, is the dropped ping pong ball.
It's perfect. It's the perfect audio analogy. Imagine you drop a ping pong ball onto a wooden table. Listen to the sound of the bounces. The first bounce is high and slow. You hear a distinct boom.
Right.
Then the next bounce is a bit lower and it comes a bit sooner. Boing, boing, boing.
And right at the very end, just before it stops, you get that incredibly fast buzzing sound. And then silence.
That buzz, that incredible acceleration where the bounces become almost infinitely fast and then the ball hits the floor and stops dead. That moment is the singularity. In the model, that's called the critical time, or $T,000.
In the LPPL model, it actually claims that it can calculate that exact date in advance.
It claims that if you can accurately fit the mathematical equation to the stock chart, if you can measure the precise speeding up of those log periodic bounces, you can extrapolate to find the point where the bounces go to infinite frequency. You can mathematically predict the date of the rupture.
That is an incredibly bold, incredibly controversial claim. It implies that the crash is baked into the cake, sometimes months in advance.
That is the core argument of the whole theory. The crash is not caused by the bad news of the day. It's not because Lehman Brothers failed or because some government report came out. Those are just the pins that pop the balloon.
The triggers.
They're just the triggers. The crash is the necessary, inevitable end of the super exponential dynamic. The ping pong ball has to stop bouncing eventually. The system has built up so much internal tension that it has reached a point where it can no longer sustain itself. The rupture is a release of that tension.
So the LPPL model is a kind of thermometer. It's measuring the rising pressure inside the system, not predicting the specific event that will finally make it burst.
A perfect way to put it, it measures the inflation of the balloon, not the precise location of the pin that's going to pop it.
Now, I want to pivot here because this has been very focused on physics. We've had balls in bowls, spinning tops, bouncing ping pong balls, but there's a huge and I think maybe even more intuitive section of this stack that says, stop treating the market like a machine. It's not a machine, it's a jungle.
Yes, this is where we enter the world of market ecology. And for me personally, I think this is the most powerful and explanatory framework we have. It comes from the work of researchers like Martin Skoll and Doyne Farmer.
And the core idea is simple but profound. Treat different trading strategies as if they were biological species.
That's right. Forget about individual traders. They're not the unit of analysis. The species is the strategy itself, like value investing or trend following.
And the population of that species is the amount of capital, the amount of money following that strategy.
Exactly. So if a strategy is successful, if it's profitable,
It gets fed, its population grows, it reproduces as more people copy the strategy and more money flows into it.
and if the strategy starts losing money,
It starves, the population shrinks. And if it loses enough, the species can go completely extinct.
Now, the paper gives us a beautiful, simple toy model to understand this ecosystem. It has three main species. Let's walk through them. First, you have the very bottom of the food chain, the noise traders.
Who are they?
The noise traders are the plankton of the financial ocean. They are the random element. They are people buying and selling for reasons that have nothing to do with a sophisticated strategy.
Like they need to sell some stock to buy a car, or they just got their pension and they're buying an index fund.
Precisely. They're not trying to beat the market. They just provide the background liquidity. They are, in essence, the food for the other species.
Okay, so then you have the first group of predators, the value investors.
I'd call them the grazers, like wildebeest on the savannah. They are the stabilizing force in the market. They look for what they believe is the fundamental value of a stock.
So if a stock is trading at $100, but their analysis says the company is really worth $110, they buy.
They buy. They eat the mispricing. And in doing so, they push the price up towards that correct value of $110. They are the market's immune system, constantly pulling prices back towards reality.
And then we have the apex predators, the trend followers.
The trend followers are the lions. They are the most dangerous and destabilizing species in the ecosystem. They do not care one bit about fundamental value. They don't know if the company makes computer chips or potato chips.
They only care about one thing.
Motion. Is the price going up? Buy. Is the price going down? Sell. That is their entire strategy.
They chase the herd.
They create the herd. And this brings us to a critical biological concept called density dependence.
Okay, what does that mean?
It means that the success of your strategy depends entirely on how crowded your particular niche is.
Okay.
Let's take the value investors, the grazers. Imagine there are only a few of them in the whole market. For them, it's paradise. There is food everywhere, all these juicy, mispriced stocks. They feast, they make enormous returns.
But because their returns are so good?
Everyone wants to become a value investor. The population explodes. Suddenly, there are millions of these grazers on the savannah. What happens?
They eat all the food instantly. Any mispricing that appears is corrected in a nanosecond. The market becomes too efficient.
And there's no profit left. They literally starve themselves to death by being too successful. Their success is negatively density dependent.
Okay, but now look at the trend followers, the lions. What happens when their population grows?
Something very different and much more dangerous happens. If you have $1 billion of trend-following capital, and it all decides to buy at the same time,
It creates a huge upward spike in the price.
which validates their own strategy. They look at the chart and say, see, we bought, and the price went up. We're geniuses. So what do?
They buy more.
They buy more. They create their own food supply by inflating a bubble. Their success is positively density dependent, but only up to a point.
Until they run out of money or they run out of other people to sell to at a higher price.
Until there are no more greater fools. And at that moment, the bubble bursts and the trend follower population gets absolutely decimated.
What's so amazing about this is the relationship between these groups. The paper calculates their trophic levels, who eats whom, and finds this thing they call mutualism.
It's completely counterintuitive. You would think these strategies are mortal enemies, right?
Yeah, they're in direct competition.
But they're not. At equilibrium, they actually help each other. The value investors need the noise traders to occasionally push prices out of whack so that they have some mispricing to feed on.
They need some inefficiency.
And even more weirdly, the trend followers need the value investors to create the initial slow trend back toward the mean that they can then jump on and accelerate into a bubble.
It's a true food web. They all depend on each other for survival.
They do, in a stable state. But the crash, the malfunction, happens when that ecological balance breaks.
When one species becomes too dominant.
When the trend followers become an invasive species. If their population grows too large, the mutualism breaks down. It turns into pure predation. They consume everything, including themselves.
And there was a finding in that paper that, honestly, it really scared me. It was about how long it takes for this market ecosystem to evolve to a stable state.
The 100-year problem.
Yeah. Can you explain that?
In a real jungle, natural selection is often swift and brutal. If you're a slow gazelle, a lion eats you today. Your slow genes are removed from the gene pool immediately. The feedback is fast and clear.
But in finance, the selection pressure is, as they say, noisy.
Very noisy, which means a truly terrible strategy.
Like buying a meme stock with no revenue at the absolute peak of a bubble.
Can make you incredibly wildly rich for a year or two, just through sheer luck. The market rewards bad behavior in the short term, all the time.
So the evolutionary process is slow and confused.
The simulation of the paper showed it can take up to 100 years for capital to finally, slowly, noisily migrate from the bad strategies to the good, more stable ones.
That implies that for my entire lifetime, and your entire lifetime, the market could be fundamentally dominated by an evolutionary mistake. We could be living in an ecosystem that is structurally broken just because the evolutionary timeline hasn't had time to catch up yet.
Precisely. We are living inside the noise of a very, very slow evolutionary process.
So we have these unstable populations of strategies. Now we have to connect them all together. This brings us to section 6 of the stack, contagion and networks.
Right. And this is where we learn that the advice your financial planner gave you, diversify, can actually get the whole system killed.
Which goes against everything we're taught. Don't put all your eggs in one basket. That's the first rule of investing.
And that's great advice for you as an individual. But for the system as a whole, it can be catastrophic. This is the complexity stability paradox, a concept that comes from Andrew Haldane at the Bank of England, who worked with the famous ecologist Robert May.
And they compared the global banking network to a forest.
Exactly. Imagine a forest where the trees are all different species and they're spaced far apart. If lightning strikes one tree and it catches fire, what happens?
It just burns down. The fire stops there.
The damage is contained. The system is disconnected, and therefore it's robust.
But the global financial system isn't like that at all.
It's the opposite. It's a dense, tightly packed thicket where every single tree is connected to every other tree. Every bank lends to every other bank. They all hold the same types of assets. Their financial branches are completely interlocked.
So when lightning strikes one tree, say, Lehman Brothers in 2008,
the fire spreads instantly through the network to the entire forest.
So by trying to share the risk through diversification and connection, they actually created a system that was rigged to ensure everyone goes down together.
It's a monoculture. And we know from agriculture that in a monoculture, a single virus, a single pest can wipe out the entire crop. There's no resilience.
And once that fire starts to spread, we run into another biological concept called the alley effect.
Yes. In biology, the alley effect explains why very small populations can suddenly spiral into extinction.
How does that work?
Well, think of a population of whales. If their numbers get too low, below a certain threshold, they can't find mates to reproduce. They can't effectively defend their young from orcas. Their growth rate actually turns negative and the population collapses.
And how on earth does that apply to a bank like Goldman Sachs?
Liquidity. Think of liquidity, which is really just the number of willing buyers in the market, as the population size.
Okay.
When the fire starts, when the panic begins, fear takes over. Buyers vanish. They just disappear from the market. The population of buyers drops below that critical alley threshold.
And suddenly you can't sell your assets at any price.
You enter a liquidity black hole. No one is there to take the other side of your trade. Just like the lonely whales who can't find a mate, the market can no longer perform its most basic function. It goes extinct.
Okay, so we have the setup, the LPPL bubble. We have the warning signs, the critical slowing down. We have the fragile structure, the interconnected monoculture. And finally, the last piece of the puzzle is the mechanism of the spread itself, the Hawkes process.
The Hawkes process is the formal mathematics of self-exciting events.
Self-exciting, I love that term. It sounds so enthusiastic.
It's the opposite of enthusiastic, believe me. Think of earthquakes. You have the main shock. That single event physically changes the stress along the tectonic plates, which in turn makes an aftershock more likely to occur. The event causes future events.
Or like a viral tweet. One person retweets it, which makes it more likely that 10 of their followers see it and retweet it, and so on.
Exactly. It's the math of contagion. And in markets, there is nothing more contagious than fear. Selling begets more selling. Panic is self-exciting.
And this framework allows us to make a really important distinction between two types of crashes, the exogenous crash and the endogenous crash.
Right. Exo meaning from outside and endo meaning from within. An exogenous crash is what most people think of. An asteroid hits New York. A surprise war breaks out. A massive, tangible, external blow hits the system.
And an endogenous crash?
The market scares itself to death. A small random fluctuation triggers a bit of selling. The trend following algorithms see that selling and they sell more. The value investors try to step in, but they run out of cash. The panic spirals, feeding on itself.
The call is coming from inside the house.
The call is coming from inside the house. And the research that uses these Hawks processes shows that most of the big crashes we think of, certainly 1987 and large parts of 2008, were predominantly endogenous. There was no asteroid. We did it to ourselves.
Okay, let's try and bring all of this together. We've covered a massive amount of territory. If we were to synthesize this into a single unified theory of rupture, what would that story look like?
It looks like a 4-act tragedy.
Okay, Act 1, the buildup.
That's the log periodic power law. Positive feedback loops and herding behavior drive the price up in a superexponential frenzy. The trend follower species explodes in population, creating a fragile, unstable monoculture.
Act 2, the fever.
Critical slowing down. The system loses its resilience, the bowl flattens out. We see the statistical warnings, the wobble of increased variance, and the memory of increased autocorrelation. The internal temperature of the market rises to a fever pitch.
Act 3, the trigger.
A small, random noise event. It almost doesn't matter what it is. A disappointing earnings report, a political rumor, a butterfly flaps its wings. It's just enough to flick the marble over the edge of that very, very flat bowl. This is the moment of catastrophe.
In Act 4, the inferno.
Contagion. The initial shock travels instantaneously through the hyperconnected network. The alley effect kicks in as liquidity vanishes. The self-exciting Hawks process amplifies the panic into a death spiral, and the system ruptures.
It's terrifying, but it's incredibly ordered. It's not random chaos, it follows a script.
It seems to.
Which brings me to the final and most important question. The question I'm sure every single person listening is screaming at their phone or the car radio right now.
I know the one.
If we have the script, if we have the equations, if we can see the ping pong ball bouncing faster and faster, why aren't we all billionaires? Why can't we just plug this all into a computer and perfectly time the top of the market?
Yes. This is where we crash into the hard problem of the social sciences, the human element, or as George Soros and Doyne Farmer call it, reflexivity.
Reflexivity. The Hall of Mirrors problem.
Think about it this way. If you are a physicist studying the orbit of a planet, you can write down an equation that predicts exactly where that planet will be in 100 years. The planet doesn't care. It doesn't read your scientific paper and change its orbit. It just obeys the laws of physics.
Right. Gravity didn't change its mind because Newton wrote a book about it.
But the market, what are the atoms of the market? They're people. They're conscious traders. They do read the papers.
So if I publish a model that becomes famous and it says, based on the LPPL signature, the crash is definitely coming on Tuesday.
Then every single person who believes your model will sell everything on Monday.
And the crash happens on Monday instead. My prediction actually changed the outcome.
It invalidated itself. This is reflexivity. The system is conscious of being observed, and it changes its behavior in response to the observation. If a signal like the LPTL becomes too popular, if every hedge fund in the world starts scanning for that ping-pong signature, what will happen?
They'll all try to front-run each other. They'll sell earlier and earlier and earlier.
And in doing so, they might smooth out the very oscillations that create the signal in the first place.
They destroy the signal by looking for it.
They destroy the signal. Or they create a completely new kind of crash that we don't have a model for yet. The target is moving precisely because the target is watching you aim the gun.
That's profoundly humbling, isn't it? We have all this incredible high-level math, all this complexity theory, this biology, this physics, and at the end of the day, we are defeated by our own collective psychology.
Or perhaps not defeated. Perhaps just reminded that we are not outside observers. We are participants. We are part of the very ecosystem we are trying to map. We are not gods looking down on the machine.
So, given all that, what's the final takeaway for the person listening to this? You know, we aren't running quant funds. We're just people trying to make sense of a complicated world.
I think the takeaway is to learn to recognize the universal signs of fragility, not just in the market, but in your own life. We all live inside these complex systems. Your career is an ecosystem. Your relationships are a network. Your health is a dynamic system.
And the warning signs are always the same.
They are. If you feel like things in your life are moving too fast in a super exponential way, if you find yourself just copying what everyone else is doing without thinking, that's hurting. If you feel like you can no longer recover from small setbacks, that you have no resilience, that's critical slowing down.
If the wobble is getting worse.
If the wobble is getting worse, then maybe it's time to take some risk off the table, to step back from the cliff's edge. Don't be the one chasing the ping pong ball when it's in that final frantic buzz.
And maybe also to remember that a crash isn't always the end of the world. The forest fire clears out the dead wood so that new things can grow.
The economist Joseph Schumpeter had a wonderful phrase for it: creative destruction. Perhaps the crash, as painful as it is just the system's way of taking a deep, violent, but necessary breath.
A deep, violent breath indeed. Before we wrap up, thank you to all our partners, sponsors, and scholars who made this podcast and the research possible. We're truly grateful for your support.
And to our listeners, thank you for being part of this journey with us. If you enjoyed today's episode, be sure to subscribe and follow Stack Studios for more informative content, and support us in Patreon.
Until next time, stay curious, keep learning, and let the search for wisdom guide you forward. Have a great day.